For this video, what we're going to do is go across the pond away from the European continent, because I want to share with you my reasoning of why I think Microsoft is an attractive company right now, and I want to share with you why I bought Microsoft and put it into my portfolio. Of course, the disclaimer that this is not financial advice, but I do think it paints a pretty interesting picture for this stock. So, looking at the revenue already, we can see that in 2013, they posted a revenue of about 80 billion, which has risen all the way to 200 billion in 2022. 200 billion, insane numbers. And out of those 200 billion, 97 billion was transformed into earnings. That is a margin of almost 50%, which is something that you can only see in software and tech companies like Microsoft. They have been growing their revenue by 10%, 11% even every single year for the past 10 years, and their earnings by about 14%. But the moment that you start looking at their final 5 years here, you see a constant trend of revenue growth of 15% and earnings growth of 20%. So for the past 5 years, even though they are already very big, they still managed to increase their earnings by 20% every single year. Amazing numbers here from Microsoft. Now, recently Microsoft has been in the news because they are competing in AI with Google, which will potentially increase their numbers even more as they find an additional cash cow. But additionally, they also have a takeover bid for Blizzard for 69 billion. Now, Blizzard as a company is producing 7.5 billion in revenue and 2.3 billion of earnings before interest, taxes, depreciation and amortization. Now, looking at the 200 billion of revenue that Microsoft itself already posted, 7.5 billion is a drop in the bucket for them. But of course, Blizzard incorporates very well into the business that Microsoft already has, which is the Xbox Gaming Pass, which are many different gaming studios like Minecraft. So I think the moment they can work out the deal with Blizzard, we can see an additional growth in revenue because of this additional segment being added to their portfolio. But now the question of course is, can they afford to purchase a company as big as Blizzard in a deal that is worth $69 billion? Looking at that debt level, we can see that overall, that debt has been growing by 15.6%, so very much in line with their overall earnings growth. But I think what we can also see here is that like within 1 year of earnings, they can pay down the entirety of their debt. So debt for a company of Microsoft is very much negligible. And the rising interest rates, which are scaring a lot of people right now, are of negligent effect on Microsoft because they simply don't have any debt. So any refinancing at higher interest rates is not really an issue for them. So this then brings me to their excess cash on their balance sheet, and we can see a marvelous thing here, which is to say that they have more cash on their balance sheet than they have debt. If they want to, they can buy back the entirety of their debt right now at this very moment. So the moment that I posed the question of whether or not Microsoft can afford to buy Blizzard for a valuation of 69 billion, we see here with the excess cash that they have in 2022, they can easily buy the company of Blizzard and still pay down half of their debt. So Microsoft's balance sheet is very stable and they have more cash than they know what to do with. And this brings me then to their market cap, which has been growing by 23.3% every single year for the past 10 years. If you bought Microsoft 10 years ago, you would have been expecting a return of 23.3% in the stock price alone, which is not even including the dividends. Amazing numbers here. Enterprise value has been growing in line with market cap because there's not much debt or excess cash to speak of, because they usually are quite equal here. EV/EBITDA ratio, this is the multiple at which Microsoft trades. Now we can see here about a decade ago, they were trading at the 10 times multiples, below the 10 times multiples even. But for the past few years, the past 5 years, we see multiples of between 16 and 25 times. Now 25 times was during the COVID high, so this may be a bit of an outlier, and maybe so is the 16, because for the past 5 years they have seen a constant and steady 20% earnings growth, and it seems that for the 5 years here, if we average these numbers for the last 5 years, we see an average EV/EBITDA ratio of about 20.5 times, which I think is fair for a tech company that is already as big as Microsoft. So it already warrants a premium for its size and its low chance of bankruptcy, but it also warrants a premium because its earnings growth has been increasing by 20% every single year. Net debt to EBITDA is negative because they have more cash on their balance sheet than debt, so there is no risk of bankruptcy whatsoever in the coming years. So this then brings me to cash flow, and what we see here is a very steady increase in their cash flow from operations in line with their earnings. So this very much tells me that the accounting team for Microsoft is properly expensing all their costs. So kudos to them. We see a 13% increase, but we also see an increase of 21% in their capital expenditure, which is higher than their cash flow from operations. But of course, the moment that we talk about percentages, we have to look at the numbers themselves as well. And we see here in 2013 that they had a cash flow which is about 7 times their capital expenditure. So of course, percentage increases mean a lot less the moment that you start comparing the actual numbers themselves. So subtracting the capital expenditures from the cash flow leaves me with free cash flow, which has been growing by 11% every single year. Because cash flow has been growing at 13%, capital expenditure has been growing at 21%, so the overall free cash flow growth has been 11%. It's been growing from 24.5 billion all the way to 65 billion here in 2022. And this is all the cash that is flowing directly to you as the equity owner. This is your pro rata share of the company. And what has Microsoft been doing with this free cash flow? Well, Microsoft has been paying a dividend here for the past few years, which is steadily increasing by more than 10% every single year. They've also been buying back a lot of stock for the past 10 years, and as we can see as well, they've been doing very big acquisitions with their money. They have recently invested into OpenAI to compete with Google for their search engine, and they also want to acquire the company of Blizzard for their video game portfolio. So the shares outstanding have been decreasing for the past 10 years from 8.5 billion to 7.5 billion. They bought back 1 billion shares in the past 10 years and simply ripped them up. So looking at their free cash flow per share, we can see they had a free cash flow per share of about $3 here in 2013, which has risen all the way to 8.6 because they have been buying back shares. So of course, free cash flow is going up, shares are going down, double whammy for you as an investor. Free cash flow per share is getting double benefit out of that. Price on the stock market 10 years ago was €34.54, an amazing price for anyone who bought in at that very moment. For the past 10 years, it's been going up gradually by 25% every single year, with a high of $270 here at the end of their 2021 fiscal year. I do know they also reached a price of well above the 300, but that was not at the end of a fiscal year, so it's not included in these numbers. But historically, they have reached a price of $340 before coming back down. Free cash flow yield for a company like Microsoft, which is very big, no risk of bankruptcy, an amazing moat because they are the front runner when it comes to office software as well as operating software. They have an amazing cash flow and they have an amazing growth. So overall, Microsoft is the complete package, and of course this warrants a high multiple and a low yield. We can see here for the past 5 yield, they had an average of 3.4%. So this then brings me into the business of trying to forecast Microsoft as a business. Let's see whether or not if we buy the company right now and hold it for a decade, whether or not we can expect a market-beating return 10 years down the line. So like I mentioned here, for the past 5 years, they have continuously grown their earnings by more than 20% every single year. Now, I do think it's very hard to keep this up, unless of course their OpenAI investment is becoming very fruitful, or if they do additional acquisitions like the one with Blizzard. But nevertheless, I am not going to forecast a 20% EBITDA growth year over year, because I think it's a bit towards the high end. What I'm going to do here is be conservative, and if my conservative estimate beats the stock market, that's when I'm going to be interested. So I'm going to give them 15% EBITDA growth here in 2023 to account for any potential economic headwinds as well. So I'm going to grow their EBITDA by 15% and reduce it by 0.5% for all the years after that. I'm also going to attach a multiple of 20 times to the business 10 years down the line. We can see here for the past 5 years that the multiple has been around 16 and 25 times, and I think 20 times is nice in the middle of that. Of course, they do not grow as much in our forecast as they've been doing historically for the past 5 years, so this multiple may come down a little bit, but I'm going to give them the 20 times because that's what they've been doing for the past few years, and I want to be a little bit lenient because I already cut their earnings growth by about 5% every single year. This gives me an enterprise value 10 years from now of $643 billion, to which we subtract the debt, we add the cash, gives me a market cap of about 650 billion, divided by the amount of shares outstanding, gives me a share price 10 years from now of $860. I'm going to grow that cash flow by 15% because historically their free cash flow per share has been growing by 13%, which is equal to their earnings growth. So I'm going to give the same projection here. I'm going to say 15% for the first year and then reduce it by 0.5% for every year after that. I'm going to attach a 3.5% yield to that as well, because like we've just seen, that is in line with what they've been doing for the past 5 years. Of course, they also had lower percentages here, but I think that is a bit too aggressive for a projection, so I'm going to say 3.5%. This gives me a stock price 10 years from now of $820. So looking at the share price right now, I can buy as many shares of Microsoft as I want for $256. Taking both our projections and cutting them down the middle, I get an average share price 10 years from now of $840. This gives me a compounding annual growth rate, so an increase in the stock price itself of 12.6%. But of course, like we've seen here in our projection, is that Microsoft is also very much a cash cow, which has amazing margins on its revenue. And the moment that we include this free cash flow for them to buy back shares, pay out dividends, or do additional investments into the company, I expect an internal rate of return of 19% year over year. And like I always say, on average, the stock market returns about 10% every single year. And I think 19% for a company which is as solidified and mature and well known as Microsoft is an absolute amazing deal. And I think Microsoft right now at its current valuation is quite undervalued compared to other high market cap stocks like Apple. I think Apple is more appropriately priced, but I think Microsoft is definitely underpriced. And this is with a relatively conservative growth scenario. So the moment that I actually give them that 20% for the first year and reduce it by 0.5% after that, what you notice here quite quickly is that the compounding annual growth rate as well as the IRR is jumping all the way to 25%. But I do think that 25% is the absolute best case scenario for Microsoft, because I think giving them around 20% here for the first few years is quite lucrative. Of course, we don't know what happens. Maybe they can take a lot of market share from Google with OpenAI and they are able to make this happen. But for my forecast, which I always like to be more conservative, I'm going to give them 15%, and even that is very attractive to me. But let's see what happens if the stock price goes up or comes down a little bit. So the moment that the stock price comes down by 10% to $230, which it has been not too long ago, I think a few months, it was below the $230 range, at which point I expect a 21% IRR based on the projections that we gave it, our conservative projections that we gave Microsoft. So this is why I added Microsoft to my portfolio, because I think it's a risk-free company that has amazing potential, and even with a conservative estimate, I expect it to outperform the stock market in the next 10 years. Again, this is not financial advice. Please do your own due diligence, but this is what I think. So thank you very much for watching. Don't forget to like, subscribe, and all that good stuff. And just to remind you as well, I have a Patreon where I share my Excel spreadsheets like the one I'm using for my analyses here, as well as a stock market portfolio tracker and a prediction tracker. So if you want to have an insight into my portfolio or an insight into all the additional projections that I made and how they've been doing so far, please consider subscribing to my Patreon. That being said, until next time.